You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program for busy financial advisors and indeed investment professionals who want to learn how to incorporate options into their client portfolios, maybe some tips, some tricks, some education, some breaking buzz from the options world, and all sorts of fun stuff. We wrap it all up in the nice little package that is the Advisor's Option. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-exciting Options Insider Radio Network. 13 programs on said network, including many, many great episodes of the Advisor's Option. Where can you find all of that great advisorly goodness? Well, no shortage of places, including the mothership, the flagship, theoptionsinsider.com. Surf on over there, click on the Insider Radio Network tab, and of course, bam, you're off to the races. All 13 programs are up there, including the Advisor's Option. You can download, you can stream till your heart's content. Of course, you can also find it on all of your favorite audio platforms, iTunes, TuneIn, Stitcher, etc., and even our mobile app available on the iOS and the Android, and indeed even the Amazon App Store. So no shortage of places for you guys to find the Advisor's Option. Catch up on all the episodes you may have missed. Listen to it on your next road trip, on your next plane trip, and you'll have some good options, information, education to access. And of course, while you're doing that, of course, we'd love to hear from you guys. Send in your questions, send in your comments. We have a bunch of them to get to today, so I'm looking forward to a fun program. But before we launch the program, let me introduce my cohorts here on the old Advisor's Option program, starting off with the co-founder of Swan Global Investments. He is Randy Swan, beaming in from scenic and sunny Swan HQ over there, Swan HQ East, perhaps, in lovely Puerto Rico. Randy, welcome back to the program.
It's great to be here. What a contrast. I've spent the last 2 months in Durango, where every night it gets down to around 45 or 50 degrees at night, to a place that seems always to be 80 plus degrees. So like both places, it's good to be back in Puerto Rico, get ready for the kids to start up school in the fall, which means more time without your kids.
Yes, there are pros and cons. I think any parent will admit to that. Do you like that? Do you like Swan HQ East? Feel free to run with that if you like. All right, and also joining us here, beaming in from RCM, where of course they wear many different hats, including the RCM Wealth Advisor Division. He is Mike Cavanaugh, of course, an old friend of the network and indeed a principal over there at the RCM Wealth Advisors. Mike, welcome back to the program.
It is nice to be welcomed back. Great to be on the show and hear yours and Randy's voice again, and looking forward to talking options in the advisor space. Yeah,
a lot to chat about. I'm looking forward to it. So I think without further ado, we'll dive right on into the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, welcome to the buzz. I apologize for a little bit of the construction noise. They're doing some work in the building here, and it seems to be reverberating through the walls here into the studio. So hopefully it's not too distracting for you guys out there. We'll see what we can get done about that as we move on in to our first segment. This is indeed the buzz. This is the portion of the program where we break down some of the interesting news and developments that have happened in the options world since the last time we gathered here together on the old program, and let you guys know about it, because of course you guys are out there, you're busy, you're handling clients, you're bringing in new clients, you're managing the assets you have. Kind of hard to stay up on perhaps an asset class in the marketplace that you don't watch on a regular basis, so we do it for you. And we actually have some interesting, relatively breaking news on this one. This came out just yesterday, the day before, I believe, so relatively fresh. I was hoping to be able to get Eric from the OCC on to discuss it because, of course, this is their baby. He is indeed in town. He's only a few blocks away here from the Options Insider Studios, but he's at a conference, so he couldn't join us on the program today. But nevertheless, we're going to kick things off with an interesting development. This one coming out of the OCC, which is, of course, the parent company of the OIC, the Options Industry Council, of which Eric is a part, and of course, who are our partners here on this program. And they recently released essentially a press release and a comment letter to a number of different regulatory departments, including the SEC and others, that essentially they're discussing there's been some proposals out there in the marketplace, including a fiduciary proposal and others. I won't bore you with listing the litany of proposals that they are discussing here in the contract and of course in their comment letter. But essentially, they're coming down to a little bit of a difference of opinion in terms of what really constitutes an asset when you're talking about a retirement account. Part of these new regulations that are going through, they are essentially defining the assets that can essentially be qualified for retirement accounts. And they list in the press release here, their greatest concern is that the fiduciary and these other exemption proposals that they're discussing here would take away the current ability of investors to use exchange-traded listed options in IRA accounts. And they go through a long list. I encourage you to check it out on the Options Insider or read it over there at the OCC website if you want to read the full release. We'll just pull out, I think, the salient nuggets for you. And if you scroll down a little bit, their dispute comes to, in this exemption proposal, would permit certain advisors and financial institutions and their affiliates, et cetera, to provide retirement investor services in connection or purchase or sale of a particular asset. And that's where the dispute comes in, because they define the asset in this proposal, and this asset includes pretty much your full slattering there of investable products, except options. They define asset as a bank deposit, CD shares, or interests in a registered investment company or mutual fund, bank collective fund, insurance company, separate accounts, exchange-traded REITs, exchange-traded funds, corporate bonds offered pursuant to a registration statement of the SEC, etc., agency debt securities, U.S. Treasury securities, insurance, and annuity contracts, both securities and non-securities, which is interesting because there are some derivatives components to some annuities, but we'll get to that, guaranteed investment contracts, and exchange-traded equity securities. And that's it. That is the entirety of their definition of an asset for this proposal. And they say here it specifically includes any equity security that has a put, call, straddle, or other option to buy an equity security from or sell an equity security to another without being bound to do so. So essentially, the definition of an option. And so that was an interesting one for a lot of our audience because, of course, if these proposals are indeed put through, it may make it difficult for a lot of you to utilize options the way you like to, which is, of course, in your client retirement accounts. And that is indeed a big use case for options. They put here later on in the release, they have essentially, they estimate, and there's no real hard numbers on this, but their estimate coming out of the OCC is that approximately 15% of individual investor volume out there in the marketplace, which is a substantial portion of options volume, if you watch those numbers, it currently comes from IRA accounts. So that's a pretty large amount of volume that could effectively go away under these new proposals, and certainly makes these tools a lot less attractive for the end advisor, the end asset management community, which of course is the audience of this program. So a lot to dive into here. Maybe Randy, we'll start with you. This is pretty interesting stuff. It hits you guys on a number of fronts. Of course, you utilize these products, and of course, you also have the mutual fund aspect as well. So you work with options and derivatives in a lot of different capacities. What's your take here on essentially the OCC's response, essentially trying to step in and prevent options from perhaps becoming an afterthought in retirement accounts?
Well, I guess I'd start from the concept that I generally believe that more choice is better. I think when individuals get to have choices in terms of what they can invest in their IRAs, you end up with better results at the end of the day. Obviously, we've talked about in our program how valuable we think the proper use of options is in an investment program, and so that would be a separate topic. But fundamentally, when the government kind of acts like Big Brother and thinks they come in and tell you what you know better, it usually ends up not as positive for the end user. So, on that level, I would prefer that they make exceptions for options and allow individuals to use options in their IRAs or 401ks type programs over time. So I'm definitely for allowing people to use options. As it relates to me on an individual level, obviously we do have several mutual funds, so we think that that would ultimately push a lot of our individual SMA accounts into the mutual fund. So it's not about us particularly losing business per se, but it just comes back down to less choice is not as good.
Yeah, you guys are actually probably one of the few firms that actually is somewhat insulated from this, because you're right, you do have the mutual fund, so you have another option, pun intended, for people if they can't use indeed the direct overlay or the direct options component in the SMA account. So they could go to the mutual fund because those are allowed. Again, showing some of the odd unintended consequences of regulation like this. They would prohibit options that allow mutual funds that utilize options components and things like that. There's a lot of odd moving parts here that are bizarre and probably require a lot of second look. Certainly the fact that they would allow annuities but not options, I think, is a head scratcher to a lot of people in the business. Mike, I'm sure you probably are of similar mind to Randy and I on this one, and probably are a big proponent of the OCC in this fight.
I mean, the one thing that, yes, the short answer is yes, a huge proponent. I think this is something that the industry needs. We've been, I don't want to say fighting for this, but if you would have asked me 10 years ago, I would have said, let's do it 10 years ago. From a yin and yang perspective, anytime something like this happens, anytime there's a regulatory shift in anything, there's going to be a group of people that are looking at like, oh, now we have access to this. Let's get in there and come up with these different kinds of ideas on how to access that money using options. So it's always, you got to talk to firms like Randy's that understand options. You have to talk to advisors that can read through an offering document, because some new ideas and new things are going to come out, new products that are going to be released from firms that haven't been doing this for 18 years successfully, that just see this as a money play to get access to new funds that didn't allow a product in it. So it's like anything else, caveat emptor, buyer beware. But I think this is a huge win, I guess, for the people that have been using options the right way for a long time, as long as the people that are making the investment decisions go with firms that use options the right way. I think this is going to be very good, not just from like the very good for the industry. I think it's going to be very good for multiple different reasons. One, all these problems, it's maybe not as prevalent in different areas of the country. I'm here in Chicago, the pension default capital of the world here. I think that options in retirement accounts, defined contribution, defined benefit, whatever it is, I think using options is going to give the pensions that are troubled here some ways to begin treading water, to basically help them where they need some help in the underfunded pension situation. So from that aspect too, I think there's some big opportunities for local governments, municipalities, and different types of pension funds that are underfunded to reach out to the option world for viable methods to help them in situations. So I think it's win-win, but definitely you want to work with people that have been doing this for a while.
You're right on that front. That has kind of been a big push here in the local options community for a while. Of course, Illinois making headlines for our pretty much lack of any financial wherewithal whatsoever. Maybe a little bit of options income generation could help ease that situation a little bit. Of course, good luck at having that happen here in the state, but still a lot of interest in perhaps having something like that happen in a proposal like this certainly wouldn't help. And just to clarify earlier, I think I said SEC is actually a proposal issued by the Department of Labor. And for those of you who want to dig deep into the minutia, it's the proposals under discussion are their definition of the term fiduciary, conflict of interest rule, retirement investment advice, and the proposed best interest contract exemption. I won't bore you with the application number. You can find that for yourself, or of course go over to the OCC website and read their release, or the Options Insider. We have that information there as well. Or click on the show notes. We'll have a link there as well. But again, this is interesting stuff. Sometimes buried deep in the weeds. You may not hear about it if you're not paying attention to the options market every day, yet very, very important to all of you out there who are utilizing these products. I'd imagine the vast majority of you in your clients' retirement accounts. And this may come as a bit of a surprise to you that may all of a sudden perhaps not go away, but indeed be frowned upon in the near future. And really quickly, another little nugget here before we get into the Options 101. Randy, this is right up your alley. We touched on it a little bit last episode with Rob, getting into a little bit more. There's kind of a larger push, and I'm sure you've been keeping an eye on this quite a bit, Randy, coming out of the SEC. Really digging into the mutual fund space kind of gets to what we were just talking about a few minutes ago, how a lot of mutual funds out there are incorporating some sort of derivatives exposure. Could be selling calls for income, like we were saying earlier. Could be buying puts to hedge along equity positions. Sometimes it's bulls, sometimes it's collars. Sometimes it's something a little bit more esoteric or exotic because they're doing some sort of weird leveraged thing, 2x inverse, whatever the case may be in some of these products. So there's a lot of funds out there that are utilizing derivatives in some capacity, and I use the dreaded D word out there because that's kind of the way they call it. A lot of it is options, some futures, but a lot of it is options. And they want some more clarification from the SEC on exactly what types of exposure these funds have. It's kind of been an on-again, off-again issue. It seems like it's on again these days, and particularly as people are looking to mutual funds as relatively simplistic investment vehicles, as relatively sometimes misconstrued as safe harbors for you just buy them, you're easy to have. You get the NAV, you execute it, it's pretty straightforward. You can put it in a securities account so it's accessible to the broad audience. You don't need a special account or any sort of special approval like you would to trade options, and yet you can have all these products that may have options exposure. So the SEC perhaps taking a second look at that, and that's something that certainly will be expanding in the near future. Randy, again, you have a lot of skin in this game because you're running mutual funds now that have a lot of options exposure. In fact, that's essentially what the reason around the fund is providing that sort of risk management through options. What's your take on this, and have you seen any more interest or perhaps even received an inquiry from the SEC in terms of explaining the overall options usage of your funds?
We've launched 2 funds over the last, about 3 years. In the prospectuses and all the legal documents that we've ever filed, we go through a lot of description and analysis of what type of derivatives we're using in our portfolio. We think we're a very transparent firm. So from that perspective, I think giving more information to the end user is always best. You get into a lot of legalese and kind of stating positions that seem like, could you really read this stuff at the end of the day, reading 40 pages of a bunch of disclosures and disclaimers. But at the end of the day, I think that's a good thing for the end user because it gives people that want the information at the end of the day. As it relates to the mutual fund side, we haven't done anything necessarily with the SEC or been contacted by the SEC. I think a side issue of this that we've seen over the last year or so is that a lot of the wirehouse firms and broker-dealer firms have really increased their due diligence when you're getting approved on a certain platform or for a potential investment because of some of the alternative investment programs over the last year or so that have had issues with how they represented their track record or their actual performance or both. So that's something that I've noticed a lot, is just a lot more due diligence, a lot more scrutiny, which I don't think is necessarily a bad thing at the end of the day. So everyone ultimately gets to, if they do their due diligence, can find out exactly what you're investing in and how your strategy should really perform.
Yeah, you're right. I mean, on the one hand, a lot of people who have been in the options business for some time sometimes bristle at the notion of more regulatory oversight, more regulatory involvement, because let's face it, the track record of regulators in this space, SEC, CFTC, FINRA, et cetera, not exactly stellar. They've dropped the ball numerous times, have shown many times they don't really understand the business that well. They're much more focused on their core asset classes, whether it's securities in the case of the SEC or futures in the case of CFTC. Options always kind of a bit of an afterthought. So that makes a lot of people perhaps get a little bit nervous, a little bit cynical. But on the other hand, you're right. The mutual fund industry has grown so far, and there's so many funds out there that are perhaps, shall we say, of dubious construction, and they probably need a little bit more light shined on them. So if at the end of the day, if this can help do that and help keep some people from using some products that they probably shouldn't be playing with, then, and certainly not investing in, then perhaps that's a good thing. And all right, that's going to do it for our Buzz segment. You can check out links to all that stuff in our show notes and, of course, on the aforementioned sites. And now it's time for us to keep on rolling right on into a very timely Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101. Like the name implies, this is the portion of the show where we break down some basic options concepts and strategies and explain how you can utilize them on behalf of your clients. And today we're going to break down and kind of have a bit of a refresher on a very important options concept. We're looking, of course, it's been in the headlines quite a bit of late, and I was looking through our recent show catalog here, and we haven't really touched on the concept of volatility really directly on the program in a little over a year now. It's been since June of last year. Actually, it was episode 20 back in June 2014 when we last took a deep dive into the concept of volatility itself. Of course, a lot happening since then. We just got out of the heels. We were recording this, listeners, on July 23rd, so we just got out of the heels of the Greek crisis. Volatility has been all over the place for quite some time now, last couple of weeks at least. And a lot of people are watching. A lot of the news is commenting on things like the VIX moving quite a bit. There's been a lot of volatility of volatility. The VIX, in fact, had its largest percentage 5-day decline just last week in the product history, dropping from a little bit over 20 down to the mid to low teens. So very, very substantial movements out there. And this is probably catching a lot of people's eyes, certainly your clients. And it's certainly a good time, I think, to go back into the realm of volatility and explain some of these concepts and why they are important to you. Of course, before we even do that, I've heard some advisors ask before at events and coming up to me and writing in and saying, why do I even need to worry about vol? At the end of the day, the real risk is kind of just the risk of loss of capital, losing money. And that's kind of all I really need to worry about. The vacillation, the underlying, not really my concern. Interesting article coming out of, we've argued against that, of course, many times here on the show. You want to use options to hedge that volatility. And there's an interesting article just this month, actually, coming out of Investor Advisor magazine, kind of laying out why you really need to think about as options and volatility as an advisor, particularly volatility, because it has impact on a lot of interesting things, including something that's very important, near and dear to advisors, and that is the compounding effect, of course, central to the key for a lot of advisors having their clients build wealth. And there's a great chart in there. We'll put it in our show notes also. We'll put a link to the investment advisor article so you can read it for the full thing for yourself. But the chart is fantastic because it shows you how over 5 years, an asset worth $100 and compounding at a 10% annual return rate, and what it turns out to be at the end of 5 years is about $161. And that same asset compounding at that same 10% average return per year, but still has that first asset, of course, having no no volatility whatsoever, standard deviation of 0. Second asset having a volatility of about 17%, and how that affects the returns and how they're up 1 year, down the next, and over time. So the average return was still 10%, but the compound average return a little under 9% now. So you're talking about an asset that now has about $152 versus $161. Granted, that's a small sample size, small number, but still you multiply that times more years and much larger account sizes. You can see how volatility can have a marked impact on just even simple things like the compounding of your client's portfolio. So if you're one of these people who was, I'm not really that concerned about volatility, it's not really of interest to me, perhaps it's time to revisit that notion. So let's start off here with some of the more important concepts. Of course, when we're talking about volatility in the option space, there are really two important versions. There's the realized or the historical, which is, of course, the actual volatility that has been exhibited in the marketplace. If you look back at underlying XYZ over the past 30 days, this is the amount of volatility that it has shown. That's real. That's actually happened. And then what the options market does, of course, is because options contracted for some forward date, you have to kind of guesstimate what the volatility is going to be at that date. So that is what is called the implied volatility of the marketplace. It's the actual level of volatility that is implied by the price of the options that are currently trading in the marketplace. And what's going to happen, of course, is that the implied is, in 99.9% of circumstances, going to be higher than the realized. And the reason for that is you don't really know. Realized volatility could have been 6% last month. Does that mean it's going to be 6% this month? Probably, but maybe not. Maybe it could be higher, it could be lower. So maybe you're going to build in a little bit of fudge factor, give yourself a couple extra points, or maybe you're going to price it at an 8% or maybe even a 10% if it's a very volatile month. That's what's called the risk premium in the market, the difference between the implied level that's being priced in the marketplace versus the actual level of volatility that is being exhibited in the marketplace. And that is kind of a very key concept for a lot of our listeners because, of course, the higher level of implied volatility in the marketplace, a higher level of implied volatility in these options, it's both a pro and a con because depending on what you're doing, utilizing options, it can be a great thing or come back to indeed haunt you. Well, maybe, Mike, we'll start with you. We'll talk about some of the, of course, the pros and the cons of, let's say, if we're talking about a high volatility environment versus a low volatility environment for a financial advisor who's out there to do the typical stuff for his client, sell covered calls, buy puts, construct collars, and that sort of thing. Sometimes in an IRA account, that proposal doesn't go through.
Sure. I mean, there's so many things to consider. There's no right answer for that. The first thing I try to tell people that are advisors, right? There's a difference between investing and trading. Investing is more, longer term. You're looking to the use of options in an investing scenario. You're looking to use options to help smooth the volatility of the return to the client over longer periods of time. I would say volatility should not impact your decision-making process that heavily, whether it's high or low volatility. If you're an investor, if you're an advisor using options as an investor, I don't think volatility should impact your decision-making process from a big aspect. I will say if you're new to options and you're in a high volatility environment, it's probably not the best time to learn how to trade options or use options as an investment vehicle. It'd be like telling somebody, here's a 40-foot sailboat. It's your first time. I know there's a hurricane right now, but go ahead and go and learn how to sail. I would stay away from a high volatility environment if you haven't been using options, and you're going to start learning how to use them. But otherwise, if you're an investor, you're an advisor that's working with investors, a high volatility environment and a low volatility environment, I don't think should impact your decision-making process because you're not going to be paying attention that much to the volatility. In the low volatility markets, you're going to get less premium. The puts that you're purchasing and the calls that you're purchasing are going to be cheaper. If you're selling them, you're going to get less money for them. And you'll have to get closer to the strike if you're selling calls to pick up more money, or closer to the underlying with your strike. And the opposite's true. You'll be like, whoa, look at how much money we're getting selling these covered calls when the VIX is at 40 versus when it's at 15 or 20. So that's my answer. I'm sticking with that.
You're sticking to it, sir. Well, Mr. Randy, same question for you. You want to weigh in here on the different levels of vol high versus low and what they mean to the typical investment advisor or financial advisor out there?
Couldn't agree more with Mike. At the end of the day, if you're a long-term investor, you're going to go through cycles that things are more advantageous or less advantageous. And so what you really care about at the end of the day is how you smooth out returns, what kind of performance that strategy can generate over the long haul, knowing that you can't necessarily make a claim, oh, we're in a low vol environment, let's not ever sell premium. I think this year is a pretty good case in point. I would argue we've had a very small trading range in the market. We've also had, except for the fact that what happened maybe late last month in terms of the spike in volatility, we've had a low volatility environment, but it's been our experience that it's been a good year for selling premium despite the fact that it's a lower volatility. We also at Swan also like the concept of what Mike just pointed out is that when you have a strategy that's made up of different components, like a premium buying component as well as a premium selling component, they somewhat offset or complement each other. So in periods where there's a relatively low volatility, it may be cheaper to hedge your portfolio. It also means that your income trades, you may not be getting the kind of premium that you would like on that side, but they, as I said, they're self-compensating. That was extremely relevant to us as a firm in 2009 after the big 2008 sell-off, when insuring your portfolio was, everything else being equal, extremely expensive. The 2009 also turned out to be our best income year ever, I think, as a firm. So, we look at it as a long-term, knowing that you can't time the market, you can't really predict what's going to happen. So design a strategy that's designed to benefit in all types of market environments, and hopefully one that will ultimately provide value over a full market cycle.
Well said. Of course, the long-term perspective indeed being the one that we emphasize here on this program. Just for some basic clarification, of course, when we're talking about levels of volatility, levels of implied volatility in the marketplace, as Mike and Randy both alluded to, they're going to have some basic net effects on the prices of those options. For example, if implied volatility is relatively high, the prices of those options are going to be higher, all other things being equal. So you can certainly think in your mind what that impact that will have on your portfolio. Indeed, if you're selling those options, it's going to be perhaps a boon time for you. If you're buying options, perhaps not so much. And the opposite is true, of course, when implied volatility is low, option prices are generally cheaper, all other things being held equal. So if you're buying options, again, perhaps more attractive. Selling options, perhaps not so much. Again, that's why Randy alluded to having the types of overlay positions that they utilize at Swan and a typical type of strategy. Again, that's why I allude to the collar being that holy grail type position from an option perspective for financial advisors and asset managers, because it combines both sides of the coin. They're buying premium and selling. So you are somewhat insulated from the effects of volatility. That said, of course, the put could have different levels than the call, and it certainly will, and they'll respond in different ways depending on the product you're looking at, et cetera, et cetera. But it does help a little bit to have both sides, because while you're benefiting on one, you're losing on the other, and it'll help mitigate the overall impact. But again, you should be aware of those basic terms: implied volatility, realized volatility, and of course the Vega component of options, which is indeed the Greek that measures the options sensitivity to volatility, because you understand those, you understand how options respond in different volatility environments. Speaking of volatility environments, the name you probably hear bandied about the most when referring to volatility, kind of the standard bearer when it comes to volatility, is of course the VIX. The volatility index has been labeled, perhaps mislabeled, as the fear gauge. What is that? You see it quoted on CNBC and other outlets all the time, where the VIX is low, the VIX is high, et cetera, et cetera. What is that really? Well, it's a very simple thing at the end of the day. We talk about, the S&P 500, of course. Most of our advisors are benchmarked to it or something similar to it. What the VIX really is at its core is essentially the implied volatility, what we were just talking about, of the at the money, essentially where the underlying is trading strike of the S&P 500 at that time for the front month. There's a few other iterations that go into that calculation, things like volatility skew, et cetera. We won't get into those. But this very basic core principle, that's essentially what it is. It's the front month at the money volatility of the S&P 500 with a few extra adjustments thrown in there. And so all things considered, if it's relatively high, that's essentially showing, what's going on in the marketplace. Then it's been mislabeled as the level of fear in the marketplace. And of course, if it's relatively low, that's seen as kind of a bellwether for market sentiment. Of course, what is a high VIX? What is a low VIX? That is a very, very subjective conversation. We get into that a lot in our program, Volatility Views, if you want to get more into the deep dive from a volatility perspective. But of course, we don't have time really to get into that. That's several shows worth of discussion in and of itself, but suffice it to say, the VIX product in and of itself is widely accessible through a wide variety of tradable products. Of course, there are options and futures. There are a myriad of ETFs and ETPs listed off of the VIX, like VXX and XIV and a bunch of other things like that, and derivations of the VIX there. So there's many different ways for advisors who are interested perhaps in going squarely at a volatility-oriented product, not just an option with volatility, but the volatility product itself that perhaps may want to explore, perhaps not. These are very divisive products. Maybe, Randy, we'll start with you. We talked before, it's been a while, of course, since we talked about VIX, I think since back in 2013 on the program in terms of VIX products. But a lot of people out there have this perhaps misconception that the fact that if they buy a VIX call, which of course volatility increasing usually correlates to a sell-off in the marketplace, if they buy a VIX call, it's an appropriate hedge for a portfolio, and that they could do that, and it's essentially analogous in their mind, perhaps, to buying an S&P 500 put in terms of hedging a portfolio. What's your take on that viewpoint? I have a feeling I know which way you're going to lean, but clarify for our listeners, what's your take on that age-old debate of VIX call versus S&P put in terms of a portfolio hedge, and which way should advisors perhaps be leaning?
We typically hold the position that buying a put option on the S&P 500 is superior to a VIX call. And the main reason why is when you buy a put option, you're protected against price and volatility. There's a lot of scenarios where you could be buying a VIX call and you think the market would be selling off, but that doesn't necessarily translate into that call increasing because it's the rate of change, it's how quickly that occurs. And obviously you could have a 10 or 15% sell-off during the year of the market where VIX really doesn't move that much during the year, so it's not a perfect hedge. I think I would use VIX calls as more of a tactical asset, in my humble opinion, as opposed to more of a strategic asset in terms of long-dated or put options to protect a portfolio. So I think that would be our view is that the S&P 500 is a more perfect, more closely aligned hedge that's going to protect you in more market scenarios than just a pure increase in the VIX call that, like I said, over time may not really work in your favor. And I think you guys can get into some other scenarios where it doesn't really work out in your favor in terms of how the VIX options are priced and how they decay over time based on the futures, getting closer to expiration.
Mike, same question for you. I'm sure you guys over there at RCM are pretty much inundated at a time like this. You guys work with a lot of retail clients who probably see VIX advertised here or there or mentioned on different outlets, and they come to you and say, hey, I want to get long this VIX, or I want to get short this VIX, or how do I trade this VIX? And what do you typically tell them, particularly on this kind of age-old debate of the VIX call versus the S&P put as a portfolio hedge?
Yeah, I mean, same question. I'll give you the same answer. I mean, I couldn't, the same sentiment Randy said, and, kind of the way we look at it, we don't speculate. We're investing. And when we need to hedge an investment, the closest thing that you can find to a portfolio is buying the S&P put. If you want to hedge Apple stock, you buy Apple puts. If it's apple to apples. And the VIX is a good vehicle. I'm not saying it's just a speculative vehicle, but you really have to have, you can kind of loop the two questions into one because the answer is very similar. The VIX is more of a trading vehicle in my mind, and you can use the VIX to hedge portfolios on a volatility basis. I think it becomes a hedge. A few years back after 2008, the SIBO, and this isn't a knock on the SIBO or any of the exchanges, but there were some studies done that kind of tried to say that the VIX was an asset class. Well, if the VIX is an asset class, then it needs to be in your portfolio right now for the next 30 years, right? You can't say, well, I think the market's going down next year, so I'm going to buy the VIX calls now. You have to have it, if it's an asset class in a long-term investment portfolio, you have to have that in your portfolio all the time. And you have to be paying for the premium all the time, similar to the S&P put. I'm more comfortable with the S&P put. I'm not 100% sold that the VIX is an asset class. It might be. There were some very good supporting documentation and studies that went along with the argument that said the VIX is an asset class. Then it needs to be in your portfolio all the time. I think if you looked at 100 advisors, I'd say probably 90 of them are what I'll call traditional. I'd say 10 of them are more like a swan advisor where they've got a traditional asset base, but they're using options proactively to hedge risk and have the potential of adding income. I'd say 1 out of 1,000, if that's even the number. I don't know of any advisors that have the VIX in their portfolios as long-term asset class. That doesn't mean they're not out there. I just haven't met. I'd say 1 out of 1,000, if that's even the number. I don't know of any advisors that have the VIX in their portfolios as long-term asset class. That doesn't mean they're not out there. I just haven't met them. I think you're more prone to see people using the S&P put as a hedge versus the VIX call. And that, once again, is my story, and I'm sticking.
You're right. That is kind of a contentious debate as well. Is the VIX an asset class? The CBOE, of course, the creators of the VIX have been pushing that for quite some time. There is some interesting data, you're right, backing up that argument. But I think most people, particularly in the professional community, tend to view it as more of a like Randy referred to, a bit of a tactical allocation rather than its own asset class. That said, like Randy referred to, there are some clarifications we probably should make if you're thinking about using VIX in some capacity, or if you are using VIX. Of course, the first one, still one of the most common questions we receive about these VIX products, particularly the options, are, of course, people see this number quoted in the media all the time, which is the VIX is this, the VIX is this. That is essentially just the index, the cash index that is disseminated by the CBOE through their calculation. That really has no relevance to, not no relevance, but isn't derived from the actual tradable products that are out there. When you're looking at the actual tradable products, particularly the options, it's worth bearing in mind that VIX cash number is not what you're trading off of. It is indeed the futures. There are VIX futures. I know futures can be intimidating for a lot of listeners out there, but essentially you have to make sure you're looking at the right future, so the front month future for the near-term options, and et cetera, farther down the chain as you go farther down the options expiration cycles. And that is, of course, how you're pricing those options. And you'd be surprised, still in this day and age, of how popular VIX has become, that people miss out on that very, very basic, fundamental thing. They'll write to us saying, wow, these options are clearly mispriced, and then we'll explain to them, no, actually it comes off the futures, and the futures are here, the VIX cash is here, and then they understand. So when you're going into the VIX land, particularly VIX options, make sure you understand that very important yet very basic distinction, that you have to look at the futures, and indeed the right futures, to understand the price that your options are being derived from. And that said, too, in general, and it comes down to what is a good use case for the VIX. I agree with Randy and Mike on that the S&P put from a hedge perspective is going to be a better tool for most advisors out there because, like Randy said, it gives you the direction and it gives you the volatility component. Remember, options have a volatility component too. The VIX call, you're just getting that volatility component, essentially, that's all you're speccing on, whereas the S&P put is a more direct hedging vehicle. That said, the VIX does have moments when it does outperform. In fact, some of those studies that compare the S&P put versus the VIX calls, and there have been quite a few of them, they show that sometimes over the long term, the VIX call can outperform, but that is predicated on on the timing sequence, essentially, the time frame of the study, because if there are a few moments like we saw a few weeks ago with the Greek crisis coming into stark relief and the VIX pops, those are the moments when the VIX call really outperforms any other vehicle. So that's when the moment the VIX will move 6-8 handles in a day, and then that's when you want that upside exposure to the VIX. Then it will outperform the S&P put. The rest of the time, day-to-day trading, no, it will not. And that's kind of what Randy referred to when he meant a tactical versus a strategic allocation. You may want to consider having a little bit of those in your portfolio, perhaps as a vertical spread as opposed to the calls outright, just to capture those moments when you think the VIX is going to outperform. Again, that comes down to timing. You have to be in there at the right moment, and that could become expensive buying these calls on a regular basis. But if you want to consider VIX, that is an interesting use case for it. The one thing I would caution against as a use case for VIX, and particularly from a product perspective, a lot of people come to VIX and they use some of these ETPs that are very popular, including VXX, one of the most popular VIX vehicles out there. In fact, one of the most popular exchange-traded products by volume on any given day. This thing does a ton of volume, and that's, of course, a VIX ETP, a VIX ETF. And a lot of people view that as, hey, I think I've heard on the TV that VIX is low. I want to buy some of that. I'm going to believe in this VIX as an asset class. I want to have the volatility in my portfolio, whatever their thought process is. I'm going to buy that and put that in my portfolio as as a long-term buy and hold. That is the worst use case you could use that product for. Like Mike alluded to, it's a trading vehicle. It's not a buy and hold type vehicle, particularly with these things like VXX. They are designed for very, very short-term trading scenarios. I won't get into the minutia of the VIX futures term structure and how it disadvantages the VXX product over time, but essentially as you hold that product is eroding due to the term structure. They're buying expensive longer-term futures, selling cheaper near-term futures. That's called the roll. That is costing them money. Different studies on VXX come anywhere between 4% and about 15% a month that it loses to that impact, depending on how steep that term structure is. So bear that in mind if you're using a product like VXX, that and a lot of other VIX ETFs out there, that term structure is going to impact them. If you want to use them, it should be very, very short duration type trades, a few days at the most, and preferably even intraday if you can do it, and as opposed to a buy and hold. That is not the right case. If you want to do buy and hold longer term, you have to go out into the more direct products like the VIX futures or perhaps the options on the future. That's a better way to go. So in general, VIX, of course, we'll start at the beginning, actually. Of course, implied volatility, the level of volatility implied by the options prices out there in the marketplace. Realized is actually what's being exhibited in the marketplace. The premium is the level of difference between the two implied. It's usually going to be higher than realized. What does that mean for you? Well, of course, higher volatility means higher prices for options. Good if you're selling, bad if you're buying, essentially in a nutshell. And the VIX, of course, is essentially the front month at the money implied volatility of the S&P 500. So bear that in mind. You see the VIX bandied about. The VIX cash number you see quoted all the time, not as important as the VIX futures when it comes to what's actually trading in the marketplace. And certainly if you want to go direct portfolio hedges, S&P put's going to outperform for you 9 times out of 10 versus the VIX call, except for those scenarios like we saw recently with Greece where the VIX tends to pop. Then, of course, you have that little window you could capture where VIX as a strategic allocation, as a tactical allocation may be worthwhile for your portfolio. And last, just a caveat emptor there, do not buy and hold products like VXX in your clients' portfolios. They will lose money. That is not what they were intended for. If you want to go for a longer-term volatility play, then you want to go to the more direct products like the options and indeed the futures. So just a quick summary on volatility. I know we get a lot of questions on that. It's very timely right now. It's in the headlines quite a bit. Before we wrap up on volatility, Randy, you have a few things you want to add to the conversation?
Well, I just wanted to make an analogy probably as it relates to all the advisors. I mean, I make this this kind of pitch when we talk to potential investors in our strategies is we look at using options as more of a direct investment or direct non-correlated investment versus the VIX maybe more like, combining different asset classes together, end up with a diversified portfolio. You've got one that's more perfectly aligned or inversely correlated versus the typical diversified portfolio that you kind of hope things are non-correlated when you really need them to be non-correlated.
Well said. And of course, you can check out our earlier episodes like episode 20 if you want to hear more about volatility and VIX, or of course, our options bootcamp program. We have several episodes explaining the basics of volatility and the VIX. And of course, if you want to go deep into it, check out our Volatility Views program, where we go very, very deep into all of these fun concepts like realized volatility and VIX futures term structure. And we really get deep into the weeds if you want to check that out. It may be a little bit intimidating at first, but I think you're going to learn something over the long run. So no shortage of places for you guys to get access to some volatility information here on the network. But of course, we wanted to give you a bit of an overview, a bit of a refresher right here on the Advisors Option program because it is so top of mind to people right now in the marketplace. And without further ado, we still have a little bit of time on the program, so I want to make sure some of you guys get some time to shine on the program. So it's time to open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, welcome to our office hour segment. Like the man said, this is the portion of the program where you guys get a chance to shine with your questions and comments. He laid out all the ways you can reach us, so I won't do that. Instead, I'll just dive right on into our first question. This comes from Andrew M. It's a very topical question. We're starting to get a lot of these types of questions, so rates are on the minds of everyone these days. He writes, hey, it looks like rates will be climbing on the horizon, if not this year, then certainly in 2016. What should I, as a relative newcomer to the option space, consider when thinking about embracing these products in a rising rate environment? Does this make products more or less attractive? Any strategies that are particularly well suited to a rising rate environment? Good question. Like I said, very timely one. Mr. Kavanaugh, I think we'll start with you. Perhaps, are we going to see perhaps the looming specter of Roe emerging back on the horizon? We're going to have to start talking about the interest rate sensitivity of options, a conversation we really haven't had for the better part of the last half decade at least, because interest rates have been effectively zero for so long. But is that, you think, is going to become a consideration perhaps in the near future?
I think, Roe in options works similar to how, rise in interest rates as far as it applies to volatility in the futures market or just in bonds in general. The further you go out on the yield curve, the further the rise in the interest rate or any kind of interest rate movement is going to affect the volatility of the interest rate. A 30-year bond is going to be more volatile than a 6-month T-bill in the face of the interest rate hikes. So is it going to be an issue in investing? Probably not. It's kind of the same argument or issue as we had before, is how is volatility affected? If you're using options as a long-term way to hedge volatility in somebody's investment account, then Roe is going to have even less of an impact than volatility, which shouldn't have any impact anyway. So in the trading world, absolutely, you're going to see some, the longer dated leaps having a larger impact with the interest rates. But it isn't going to affect the day-to-day. An advisor looking at Roe, I don't think that's a good idea. I don't think there'd be anybody looking at Roe. If there's nobody looking at volatility, nobody should be looking at volatility as an investor, as an advisor working with investors. If you're looking at Roe, I may have some other questions for you.
Taking too deep of a dive, perhaps, into the old Greeks.
It's a deep dive.
That's pretty deep. Randy, same question for you. Our friend here wants to know how perhaps the looming specter of an interest rate increase end of this year, beginning of next year, may impact options going forward.
With what Mike said, the only thing I would add to that is that to the extent that interest rates are rising, I think that option-based strategies are going to become probably more used and more attractive, because we're not having to deal with the interest rate rising, hurting parts of our portfolio. So everything else being equal, if you have a traditional 60-40 portfolio where 40% is allocated to bonds, a rising interest rate environment is going to hurt that portfolio and not provide the capital preservation that they were intended to do. So it just makes everything else, in terms of what the realm that we deal with on this show, is it makes it more advantageous to have an option strategy.
A lot of agreement on the show today. I don't think it's some more contentious questions, I think, so we could have a little bit of crossfire here. Everyone's it's a love fest here on the show today. Not that that's a bad thing. It's just kind of funny. A good question. You're right. Options, for the most part, Roe, probably not going to be part of the conversation for quite some time. And certainly if you're an advisor, perhaps not ever. Again, like Mike said, it really just impacts interest rates. If they do change, it's going to impact options with more cost of carry to them, which, as you might imagine, are the longer term options. If you're trading in nearer terms, certainly in the weeklies and again in the monthlies and even in the quarterlies to a degree, Roe is never really going to become a big factor for you. If you're doing what Randy's doing, some of the longer term, a year, 2 years out, then it's worth at least understanding the impact of what interest rates have on options and what an increase could do. Again, if you want to check that out in more depth, of course, surf on over to our website or to the OIC website. They have some great information on that, optionseducation.org, and they lay it all out there in pretty stark contrast, how it impacts calls, how it impacts puts, etc. It's a good refresher if you are indeed looking at some of the longer term strategies, just to have a knowledge base of how these things work and how they impact options. Good question. Not the first person to write in about Roe and interest rates this year. I'm certainly probably not going to be the last. It's top of mind for a lot of people. As we move on to another one here, this comes from Timothy K. He writes, hey, love the show. Well, glad we could please you there, Timothy. He goes on to write, hey, great info, great insight. Well, a lot of love from Timothy. He writes, I wonder why no one else is beating the derivatives drum for financial advisors. Oh, he's using the dreaded D word. We tend to avoid that, Timothy, but we'll forgive you given all the aforementioned love that you gave us. He finishes up here. Maybe you should start your own conference series speaking to this critically underserved area of the space? Well, I hate to break it to you, Timothy, but someone already has. That's why I wish Eric could come on today, because the folks at OIC have actually done exactly what you're talking about. They have done two now, I believe, this year and several years ago, two wealth advisor summits. They do them in conjunction with the big options industry conference that occurs every year. This past year in May, it was around the April-May timeframe, and this past year it was in Miami. It moves around every year. They did theirs in conjunction with that, so it was at the same venue, same time frame. They'll probably do that again going forward just to save on logistics and costs. But it's exactly what you're talking about. It's a forum for advisors to discuss the use case of options, why they should use them, maybe why they shouldn't, and all the other interesting elements that go into that. So I encourage you to check it out. The options, again, the OIC website, they'll have information on previous events, probably even some sessions up there you can check out, and some presentations, and maybe perhaps some information on another one. I'm not sure if they've decided they're going to do one this next year or not, but stay tuned to that. And of course, next time we get Eric on the show, I'll have to ask him if they are planning on doing one of those. So yeah, no need for us at Options Insider to do it because it's already being done. That's the last thing we need is yet another event to handle or another logistical type thing to handle. That said, Mike, you guys are doing a kind of a similar thing, but for the CTA crowd. So maybe perhaps you can enlighten some of our listeners if perhaps they're interested in more of the commodity side of the space, what you guys are doing with your roadshows.
Yeah, I mean, the roadshows that we're doing, and that was the first thing that came to my mind when I saw this question. It's similar. It's an educational event program that we're doing to get advisors, different registered investment advisors and high net worth investors educated what managed futures are and where they belong in an investment portfolio. So it's very similar, the same concept. We just have a larger client base and a larger following in the managed future space. And a shout out to our team internally here. There's a Jeff and Blake that are on our creative team that put stuff together. They just got mentioned in Investment News this month for a infographic they put together that showed how managed futures and all the other different asset classes performed in the last 5 bear markets. And it's really helpful, and I'm happy to share that with you, Mark and Randy, and whoever else is listening, if you want to see that infographic. But it really helps. You could do the same thing with the options to see how the different asset classes perform, because that is what managed futures, and in the same concept that in any kind of option hedging that you're doing, that's what you're using it for. And you can't just decide risk on, risk off. You have to have these hedges in place the entire time that you're investing, because the days and the months and the years that it is a bear market, that is the insurance policy that you're putting in place for the whole time. So it's very similar. Happy to answer any questions that Charles had about those events, and maybe it's something that down the road we can integrate the options into, relationships like Randy with Mark and with the OIC. We could talk about potentially making it a bigger show. Happy to chat with anybody in the industry that wants to talk about the educational seminars that we're doing. We just got back from Boston. The highlight of that trip, outside of the educational series, was they were filming the movie Ghostbusters at our hotel. There may be some cameos.
The all-female Ghostbusters.
The all-female Ghostbusters. There might be some cameos of RCM employees running around the Ghostbusters set. We'll see when the movie comes out.
I think you'd make a great Slimer ghost. That would be good for you, I think.
I think it would be. And then our next educational seminar is in October, the first week in October 7th and 8th in Houston, Texas. So come on out.
There you go, Timothy. If you're in the Houston area, you can check it out. Surf on over to RCM, of course, to learn more. And, of course, check out OCC, or the optionseducation.org, the OIC site of the OCC there, to find out more information on previous events, and perhaps if they're planning another one in the near future. Who knows? Perhaps maybe in the interim, we will do something eventually, maybe with the RCM guys or others, because there's one thing there certainly is perhaps enough education and information being shined on this particular area, the financial advisor space. Everyone's talking about robo-advisors, et cetera, all these other things, and no one's really talking about this corner of the space except for a handful of events, so there certainly could be room for more. It certainly is not crowded. It's just whether we have the bandwidth to do it or not, but it's certainly an interesting area and one that perhaps is worth exploring. Great question, Timothy. Great question to everybody who wrote in. I'm sorry we don't have much time to get to any more for now. Maybe so many people writing in. Maybe we'll have like an all questions episode one of these days just to get more of you featured on the show because we have a lot of great stuff coming in. But unfortunately, it's all the time we have for our office hours for this episode. It's also all the time we have for this episode of The Advisor's Option. But before we go, as always, let me check back in with my cohorts here, my partners in crime on the Advisor's Option program to see what they have cooking. Randy, we'll start with you. I know every time I talk to you guys over there at Swan Global Investments, you have another thing in the hopper, more mutual funds, more products, different things you're doing with the overlay, different other adventures going on over there at Swan Global. So give us an update. What are you guys cooking up over there at Swan Global that may interest our listeners?
Well, we just launched a collective investment trust, or a CIT, I think in the month of July, so we're pretty excited about that. As I said earlier in the show, we always think having more options for investors is always better. So along those lines, we want access to the retirement community, notwithstanding what that proposal was. This is something, like I said, that will allow clients to have a different way to manage market risk as opposed to the traditional kind of asset allocation, modern portfolio theory. So we're pretty excited about that launch. We've added, I think there's 5 options in this program. It's different level and degrees of the DRS on the S&P as well as other underlying assets that we are applying our same strategy to. So we're pretty excited about that.
Good stuff. And where should they go if they want to check out all of that in much more detail?
I think we've added that to our website, but we're in the process of sending that through compliance. So it should be probably on our website probably in the next 2 to 3 weeks. We also will have another version of the GB and U, the good, bad, and the ugly that, in fact, I just finished writing today, and it should be out by the end of next week on our website. So anyone interested in reading that, so there's some pretty good sections there in this issue.
There you go. Surf on over to swanglobalinvestments.com to check it out for yourself. And Mike, you just gave us the rundown on your events. You have something coming up in Houston in October. What else is cooking over there in the land of RCM?
Yeah, we, in addition to our educational series, we like to lighten things up a little bit here at RCM as well. And we've got a number of different partners. If you're going to be in Chicago on Thursday, August 27th, we're going to do a little open house for the neighborhood here. Once a year, we just kind of open up the office and have some beers with our neighbors. So if you're in Chicago, August 27th, give us a call. We'd love to show you around the office and pepper you with sales material and have a beer with you. So give us a call if you're in Chicago on August 27th.
There you go. Check it out at RCM to learn more. Many different sites there. Of course, RCM Futures, RCM Wealth Advisors. So pick the subsidiary that interests you and then go forth. And be certain if you're in the Chicago area, check out that event. Who knows? Maybe I'll even swing by. I don't mind being peppered by sales material on a regular basis. Yes,
that was my attempt at a joke. I think we don't even have sales material, I don't think.
I've been to a few of their events. Don't worry, listeners. It's much more of the beverages, less on the pepper. So check it out if you are in the area and you are so inclined. And of course, Eric couldn't be here, but check out everything cooking over there at optionseducation.org. A lot of great studies like we profiled here on the show in the past. They have great data. Go check out all of those on the site. A lot of great basic explanations. If you want more detail on some of the concepts we're talking about here, volatility, interest rates, the basics of calls and puts, it's all there to check out. Of course, some great shows, including another show they do on our network here, The Wide World of Options. They explain all this fun stuff in a lot of great detail. Have a lot of great guests on that program, too. You can access that there as well. So no shortage of great content. Surf on over there, optionseducation.org, to learn more. And on behalf of Mr. Kavanaugh and indeed Randy and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and, of course, for sending in such great questions. Keep them coming. Read them all if you don't get a chance to answer them all on the air, so we'll make sure we get back to you if you have a pressing question. And we'll see you next time right here on The Advisor's Option.
The The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.